Are mutual funds really safe, or are they just another risky gamble in the financial market? With millions of Indians investing their hard-earned money, it's time to find out the truth. Stay tuned, because today we're breaking down everything you need to know about mutual funds, their risks, safety, and how you can make informed decisions. First things first. What exactly are mutual funds? Imagine a pool where many people, like you, contribute money. This pool is managed by financial experts who invest the money into various stocks, bonds, and other securities. And what's the goal here? It is to create wealth over time while minimizing risks through diversification. In India, mutual funds are regulated by the SEBI, or the Securities and Exchange Board of India, which ensures transparency and accountability. But does this mean your money is completely safe? Not all mutual funds are created equally. There are different types: equity, debt, hybrid, and even sector-specific funds. Each comes with its own set of risks. For example, equity mutual funds, which invest in stocks, can be volatile, especially during market downturns. For example, remember the market crash of 2020 during COVID-19 pandemic? Many equity mutual funds saw significant drops. However, debt mutual funds, which focused on bonds, were relatively stable. So ultimately, the safety of your investment depends on the type of fund you choose and your financial goals. But now you must be thinking, how can you ensure your investments are as safe as possible? Here are some practical tips. First, understand your risk appetite. Meaning, are you comfortable with high risk, or do you prefer stability? Choose your funds accordingly. Second, diversify your investments. The best way to do this is not to put all of your money in one fund. Spread it across different types to balance risk and reward. Third, check the fund's track record. Look at the fund's historical performance. However, at the same time, also keep in mind that past performance isn't always indicative of future results. Fourth, monitor expense ratios. Higher expense ratios can eat into your returns over time. And most importantly, stay updated on market news, because economic events can impact your investments. For example, recent hikes in interest rates by the RBI affected debt fund returns. Let's explore some real-life examples to understand the potential of mutual fund investments. Consider the case of Monthly Systematic Investment Plan, or SIP, of 10,000 in the ICICI Prudent Value Discovery Fund, initiated in August 2004. Over 20 years, this investment grew to approximately 2.30 crore, reflecting a compounded annual growth rate, or CAGR, of 19.41%. This underscores the power of disciplined long-term investing in equity mutual fund. On the other hand, consider the experience of investors in sector-specific funds, such as those focused on the technology sector. In the early 2024, these funds faced declines due to market corrections, with some losing over 5% in a single month. This highlights the risks associated with concentrated investments in specific sectors, especially during market downturns. These examples show the importance of aligning investment choices with individual financial goals and risk tolerance, as well as the necessity of diversifying portfolios to mitigate potential losses. The mutual funds in India are evolving rapidly. In December 2024, inflows into India's equity mutual funds increased by 15% month on month, crossing over 400 billion rupees. This marked the 46th consecutive month of inflows, an unprecedented streak. Small cap and mid cap funds saw significant growth, with inflows into small cap funds surging by 4.3% and mid cap funds by 13.5%. This trend indicates a growing interest among investors in diversifying their portfolios beyond large cap stocks. Additionally, SEBI is encouraging fund houses to promote small ticket investments such as 250 rupees monthly SIPs to increase equity market participation. This initiative aims to target investors in smaller towns, thus expanding the market beyond major cities. About 225 million investors currently use SIPs, contributing an average of 223.6 billion rupees monthly into equities in 2024. So, are mutual funds safe? The answer lies in how you approach them. They're not entirely risk-free, but with the right strategy, you can minimize the risks and maximize the rewards. Remember, mutual funds are a tool for wealth creation, not get-rich-quick scheme. If you found this video helpful, don't forget to like, share and subscribe. And let us know in the comments what's your biggest concern about investing in mutual funds. Let's discuss.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.